All right, everyone. Well, thank you for joining us. We will get started here in just 1 minute. I appreciate you making the time to be here with us. All right. Well, I want to thank you today for being here. My name is Alex Barron. I hope you can hear me well. I want to thank you for making the time to be here. I'm going to try to make this presentation as quickly and as interesting and relevant to you as possible. I appreciate you being here. My name is Alex Barron. Today I'm going to be telling you a little bit about myself, and I'm going to be discussing some of the issues that investors are facing today. I'm going to be talking a little bit about what Diamond Crest Capital is and how we are taking advantage of the current environment despite what's happening with COVID. Um, I'm a resident here in El Paso, Texas. I grew up here. I went to university here at the University of Texas at El Paso. I studied a degree in engineering, and then I went off to Stanford University in 1996 to work on a master's and on a doctoral degree. I then started my career in Wall Street in 2001 at Franklin Templeton Investments. I was there for 2.5 years. Then I left and went to JMP Securities, which is an investment bank focused on the housing market. And then I started my own business with a partner in 2007. And then I went on my own 100%, started a business called Housing Research Center in 2010. I then started Diamond Crest Capital 4 years ago in 2017, and our mission is to help people achieve financial freedom and security through alternative investments and through financial education. So these two companies basically come together in a way that's pretty unique. I've been working on Wall Street, as I said, for 20 years, advising hedge funds and institutional investors on how to invest in the housing sector, particularly in the home builders. And I was one of the first analysts to correctly predict the top of the housing bubble back in late 2005, early 2006. And I was warning investors to get out. I helped many institutional investors make billions of dollars by either getting out of the way or shorting that housing crash, which happened. And the market didn't ultimately bottom till 2011. We were the only analyst on Wall Street to call the bottom correctly to the day. And since that time, we've generally been more constructive on the market, more bullish, as they call it. And this year, it's been a little bit more challenging, to have to navigate the ups and downs of the market. But I can say, that over the last 20 years, I've had a very successful career in terms of modeling and understanding what's happening in the housing market at a nationwide level. So let's talk about today a little bit of the problems that different investors are facing. Many investors work for a lifetime trying to accumulate some money potentially for their retirement, right? And many of the traditional solutions are things like, retirement accounts, 401ks, IRAs, mutual funds, etc. And a lot of people trust their financial advisors to tell them, where should I put my money to work? Well, sometimes they give them good advice, sometimes they don't give them such good advice. But at the end of the day, what we should all be thinking about is that someday when we choose to retire, we're not going to be and able to work anymore. We need our money to work for us, right? We need to be able to make that transition where we go from accumulating money to actually enjoying and having our money work for us. Now, there's basically two paths here. If you follow the traditional path, they're going to tell you, well, just take out 3 or 4% of your portfolio and live on that money, and hopefully you don't run out of money before you pass away. But these days, people are living well into their 80s and 90s, and so what you really want is you want to be able to transition into a situation where you're making passive income and where your capital is not going down, right? Where in fact it has the potential to go up. So right now, there's going to be probably a crisis, over the next, 10 to 20 years in terms of retirement. Why? Because Social Security is going to be bankrupt. A lot of experts say by 2035, pensions are no longer living up to expectations. And so for a lot of people, the ability to retire is going to be a challenge. Now, we understand that many of you may be in different parts of your economic cycle. You may be young, you may be middle aged, you may be older. And so a lot of people sometimes approach me and they say, well, what should I invest in? Should I leave my money in the bank? Because, it's risky out there. Should I invest in gold? Should I invest in the stock market? Should I invest in real estate? Nowadays, people want to know if they should invest in cryptocurrencies. Well, I think the correct answer depends on where, your risk profile, your personality, where you are in terms of your goals. And that's something that we help people understand, through a one-on-one consultation. But at the end of the day, I think that there's basically four ways to look at investment. It depends on whether your goal is to be an active investor where you're basically pushing the buttons, or where you're more of a passive investor where you want somebody else to do it for you. It also has to do with whether your goal is to basically focus on appreciation or growth, where you don't need current income, or where your basic need is to have some cash flow coming in the way of income. So different investments fit different profiles. Now, we actually have both growth and income, as we'll see in a minute. But let's talk about people who used to rely on banks. Well, banks nowadays, the Fed has been lowering interest rates for the last almost 35 years, and basically interest rates are now at zero. Ever since COVID crisis started in March, the Fed had to drop interest rates to zero. And so what that means is that if you leave your money in the bank, you're not going to earn very much. At best, you might be making 1% if you put it in a CD, but that's basically locking your money away without having access to it, or having to pay a penalty for getting virtually nothing. It doesn't even cover the cost of inflation. Other people say, well, then I'll just put it in the market, right? But that we've seen that the market can be pretty volatile. And so the closer you get to retirement, that could be a challenge. It depends, how much time you have until you actually need your money. And what happens if you happen to retire, in an environment like what happened in 2008, or like what happened, in March this year, where suddenly your capital goes down 50%? Well, right now, it may or may not be the right thing for you. You may not want the stress of having to look after your investments and wonder what's going to happen, in the future. Other people choose to invest in real estate. They say, well, I'm just going to buy a rental house and I'll rent that out. But the thing about real estate is that if you have a mortgage, you're not making much money on that property. You're kind of dependent on appreciation. But we know that appreciation in real estate, can be a little bit tricky. We saw what happened during the housing crash. A lot of people lost their homes. The capital you have tied up in those homes is illiquid. If you need access to your capital, you can't exactly tap into it unless you refinance. And the only time you really make money is when the house is paid off. But then, by that time, you may be spending a lot of your money in repairs and management fees and so forth. So at the end of the day, I don't think real estate, in terms of rental houses, is such a great vehicle. A lot of people then have said, well, what about if I invest in cryptos? That's the new thing. We heard that some people became millionaires investing in Bitcoin. The problem is nowadays there's a new crypto every day. There's over 2,000 cryptos. I think many of these things will end up being scams, and I think a lot of people are going to end up losing their money. Some already have. So the question is, which ones are going to survive, which ones are not? So let me kind of tell you about Diamond Crest Capital and why we're different. And, I'm going to talk to you about our two funds, the Diamond Crest Housing Income Fund and the Diamond Crest Housing Growth Fund. So as I mentioned, 10 years ago, I started my business Housing Research Center. And what we do is that we go around the country basically doing research on the top 20 home building companies in the nation. And we write research reports to help institutional investors understand where to invest. Well, about 4 years ago, I decided to not just tell other people what to do, but to help people invest their money. So I started Diamond Crest Capital. We have been seeing over the years many opportunities to invest people's money. So in our income fund, our goal is to earn pretty steady returns of 7 to 8% per year, and to pay people out a 6% dividend yield that they can receive in cash income on a consistent, predictable basis. And in our growth fund, our goal is to earn at least 15 to 20 or 25%. So why do we focus on the housing market? Well, to some degree, I think it's a very interesting industry simply because it's something that's never going to run out of style. It's something that's a basic human need. Everybody needs to live somewhere, right? It's something that as the population grows, we need to continue to build more houses. It's also something that right now, lots of millennials had not bought a house up until now and so from a demographic perspective, the next 10 years looks pretty promising. Also, a lot of baby boomers right now are deciding that now's the best time to sell their a big existing two-story home and buy, downsize to something smaller. So the bottom line is that over the next decade, we see a lot of demand. We think there's going to be 40 million millennials who want to buy their first home. There's going to be 40 million baby boomers who are retiring who want to downsize to a smaller home. Now, ever since the housing crash that happened, a decade ago or over a decade ago, a lot of builders decided to avoid building affordable homes. So for the last decade, there hasn't really been any new supply of affordable houses. But yet that has started to change in the last couple of years. As we've gone out to do our research, what we've seen is that builders are now starting to build affordable houses pretty much everywhere. And what's happening is that as home prices are coming down, home sales are going up. The other factor that's helping is that interest rates have been coming down. Nowadays, people can get a mortgage, a 30-year mortgage, sometimes for 3% or less. And that's also driving home sales to go up. So the combination of lower prices and lower interest rates is creating a boom, for people who want to buy a home. So why do we focus on home builders? Well, I think home building is an interesting industry, like I said, because it's not going anywhere. It can't be outsourced overseas to China or to Mexico or to any other country. It's an industry that's consolidating. So what that means is that the bigger players are becoming bigger over time. It's an industry where there's still a lot of inefficiency. And so whenever there's innovation, it creates big jumps in profitability. Why Diamond Crest? Well, we have 20 years experience, which is something that very few people can say in this industry. We've seen everything from peak conditions to the worst conditions. We continuously, every day, our team does due diligence on these top 20 home builders. I have a team of over 20 people who help me out to do the research. We track data, excuse me, on over 7,000 communities every quarter. And every month, we're constantly tracking lots of things like the home prices, the home sales, the volumes, the inventories. And basically, we invest alongside our clients. We've been doing on the ground, boots on the ground research, like I said, so that we can get to know these companies inside out. So we know exactly who we're investing in. We know where their properties are. We know what kind of homes they build. We know who their clients are. And we've developed a big network of salespeople that we talk to on a regular basis and that we go visit so that we can understand what's happening on the ground. We're based here in El Paso, Texas, which is a very convenient location since we're only 1 or 2 hours away on a flight to the biggest 80%, the most important 80% of the markets. The advantage that we have investing, or that you would have investing with us, is that instead of investing in non-liquid assets such as land or private companies or single family homes, we actually invest in public entities and we invest in public security. So what that means is that there's always an active market. We know what the values are. We can figure out when there's discounts in the market we can take advantage of. If the housing market were to start going down, we can easily exit and go short. Instead, we don't have to stay long. And basically, we just, make better returns than being stuck inside some illiquid security. So now let me tell you about 3 ways that you can invest with us, depending on your risk profile and what it is that you're trying to achieve. So I've developed something called a housing growth fund. And what we do is we invest in the stocks of these home builders. We focus on the stocks that have the biggest growth potential with the lowest price value so that we can basically get a bargain. Our goal is to earn, like I said, anywhere from 15 to 25% annual type returns. So far this year, through the end of September, we've actually generated a 42% return year to date. And since we started the fund nearly 4 years ago, we've returned 104.5% to our investors. We also have the income fund, and the income fund basically focuses on investing in bonds and companies that have a high dividend yield. And our goal here is to basically return 7 to 8% to our investors. We pay out a 6% dividend yield. Every quarter we pay out 1.5%, and the fund tends to go up about 1 to 2% annually as well. Since we started this fund, total returns have been 30%. We also have another program that I'm going to tell you more details about in a minute, but basically we pay a monthly interest rate to people who don't want to risk their principal, who just want a steady principal, but want a nice return that's better than banks. So we pay them 5% to lend us their money, and then we'll invest the money for them, but take the risk. These people don't have to take the risk. So let me tell you a little bit more about the Housing Growth Fund. So the Housing Growth Fund is a volatile product. It is, higher risk. And so this is more suitable for somebody who has a long-term time horizon. It's not for somebody who's going to be worried about, quote, losing money every other month, because there's some months where we make money, there's some months where we lose money. But over the long haul, we've been successful in, generating very strong returns. So as I said, since inception, we're up 104.5%. And so for somebody who has a long-term perspective, this could be the right solution for them. And if we look at what the S&P 500 has done so far this year, it's only up 1.25% year to date. Imagine that. You're making the same thing as having your money in a bank CD, and yet the stocks have been going up and down, all year. Since we started our fund, the S&P 500 is up 43%. So we've more than doubled, what the S&P 500 has done over the last 3.75 years. The second product that we started is the Housing Income Fund. So as I mentioned, the Housing Income Fund, we invest in securities like bonds that have very low risk of default. In fact, none of the companies that we invest in have ever defaulted on their debt. Most of these companies have been around anywhere from 10 years to 60 years, and they've always paid their interest on time, and they've never defaulted on their principal. So basically, we are investing in high quality companies, liquid companies, publicly run, publicly managed companies. And yeah, there's a little bit of volatility in terms of your principal, but if you can live with that and you also have a longer term horizon, then you're looking at earning roughly a 7 to 8% total return. Of that 7 to 8%, what we do is every 3 months, we add up all the interest that these companies pay us, and then we take a small fee and then we pay it out to our investors. So investors get a 6% consistent, predictable passive income of 6% per year. So far, we've declared and paid out 15 dividends since we started. And the total return for investors who started since the beginning has been 30% so far. If you compare this versus a bond index such as the Corp, this index is now paying out a 2.5% dividend yield. And that's actually down. If you had invested in this fund last year, you would have made 3%. Now they're only paying out 2.5%. Why? Because as interest rates come down, they've been actually paying out a lower interest rate, whereas our fund has actually maintained our dividend yield very steady. And in fact, we're looking at potentially going up next year, not down. So, and the third way is for people who say absolutely like, look, I don't want to risk my money. I just want to have access to it whenever I need it. We started offering what we call the preferred loan program, where basically you lend us your capital. There's no minimum period. The other two funds have a 1 year minimum period. This one, you could give it to us for 6 months if you want. And basically you make a 5% interest rate. Every month we just deposit your interest direct into your bank account via ACH. Your principal is fixed and guaranteed, so that means there's no upside, there's no downside. And all we ask is if you need your money back, just give us a 30 days notice so that we can have it ready for you. The minimum amount for this program is only $5,000, so it's, it could be suitable for a lot of people. There's no penalty to withdraw the money early. If you compare this versus keeping your money in the bank or in a CD, which is only paying you 0 or 1%, could be significantly better than that. And it's much better than what insurance companies pay through annuities, which is usually a 2 or 3% interest rate. So just to kind of summarize, we're not like everybody else. We're not a mutual fund. We're an alternative hedge fund, and we don't have thousands of investors. We actually only have limits to invite 100 investors per fund to be part of, to invest alongside us. We invest in the top 20 home builders and other public that are housing companies. We research and analyze each and every one of these companies that we invest in very diligently. We invest our own capital alongside our clients so that we basically take in the same risks as our clients. And basically, all the companies that we invest in offer solid growth, stable cash flows, liquidity, and daily valuations. So, this is, for example, a summary of our income fund. And just to give you an idea how it's broadly diversified across companies, across maturity dates, across interest rates. And so, basically, whenever somebody pays us the capital back that we lent them, we just recycle the capital and put it back to work in something else. Now, who could this be suitable for? Well, these funds are suitable for accredited investors who basically are looking for an alternative investment to either their typical stock market or retirement account, or rental properties, commercial or residential, and where our interests are aligned, where you want better returns, where you want somebody with experience looking after your capital. This could be also suitable for somebody who's near retirement or who's already retired, who doesn't want the ups and downs of the stock market. You could invest in our income fund or in our preferred loan program and make better returns in a CD, and better returns than having your money exposed to the risk of the stock market. It could be for somebody who's a beneficiary, somebody who just received a big death benefit, or a large sum of money, who needs to put that money to work. Somebody who doesn't know, doesn't want to leave it sitting in the bank earning nothing. So we can help you out, put together a strategy to do that. It can also be suitable for institutional investors, somebody who wants exposure to the housing market but who doesn't know these companies as well. And so we can help you to manage that money as well. If you're interested, as I said, each of our funds only has 100 spots available. So that means there's still a few spots available in each of the income fund and the Diamond Crest Growth Fund. The minimum investment that you need to open an account is $10,000. And so if you have this kind of capital, basically we just need to verify your identity through your driver's license, do just a quick background check, and basically fill out some paperwork that explains how the fund works, the rules, and the risks. And basically, you could be on your way. And basically, we just ask that if you're going to invest in either of the income fund or the growth fund, that you keep the money at least in there for a year. Otherwise, there's a 5% penalty. After the first 12 months, there is no more penalty. If you need your money back, part of your money back, we just ask for a 30-day notice. As I said in the other program, there is no limit to how long you need to keep the money with us. All of our funds are managed by third parties. We have actually, let me show you here. We actually have third party Tower Fund Services that takes care of the monthly statements and of managing the money. They also do the accounting for us. Then we also have another third party, which is Richie May, a company out of Colorado, who does our taxes and who does our annual audits. So everything that we do is above board. You don't have to be concerned about any of that. The fees that we charge to manage these funds, we charge 1% of the capital that you deposit with us in the income fund and 1.5% in the growth fund. And then anything that's above that, we split basically the profits. 85% goes to the investor and 15% goes to us. And as I said, the returns that we are able to net right now to investors is about 7 to 8%. And so far, we've actually beat our target of delivering 15 to 25% for the growth fund. So if you believe that this is something that's of interest to you, I invite you to take down my contact information, contact my office, my assistant. Her number here is 915-504-4225. Her name is Anna. or you can call me on my cell, 415-425-6434, send me an email, and I'd be happy to schedule an appointment to go over your personal situation. With that said, I am going to see if there's any questions at all. And if there is, I'd be happy to take them now. I believe you can, um, let me see. Oh, this isn't a typical webinar. Well, I may not be able to answer your questions as I thought. So I apologize about that. But if you have any questions, take down my email or give me a call. I'm happy to talk to you about this and give you more details. I'd like to see if there's any questions at all at this time. Feel free to send me an email, call my office, call my cell phone. I'm here basically for you 24/7. And hopefully this was helpful to you so that you could understand more of what we do, how we help clients make money, especially in these turbulent times, where the stock market is just, like I said, been going up and down and basically making people no money, and where banks are not giving you any good returns. I think that these two funds have provided very good returns for people given everything that's been going on. I think that you're working with somebody whose capital is aligned with yours, whose interests are aligned with yours, and basically where experience is going to help us navigate the future. And like I said, right now the future for housing seems pretty bright given everything else that's going on. So again, I want to thank you for your time today. Um, I apologize that I thought I was going to be able to take questions, but this is not a meeting. This is actually a webinar, so it doesn't have the typical chat box. But like I said, send me an email, give me a call. I'd be happy to talk to you. And I want to thank you again for being here with me today. I wish you a very wonderful day. Thanks. Take care. Bye bye. Oh, it does have a chat box. Okay, well, if it has a chat box, great. I thought it didn't. Well, feel free to send me any questions if you have some. I'd be happy to entertain them. I won't keep you too long, but I'm glad to see there is a chat box. For some reason, I hadn't seen it. All right. Well, if there's any questions, feel free to send them in. I won't mention your name. If there isn't, like I said, if you want to just talk offline one-on-one, feel free to send me a call or an email. All right. Well, great. I don't see anything. Um, Thank you and look forward to talking to you soon. Have a great day. Bye-bye.